Texas production more than doubling under the current management team, positive cash flow supporting the existing business, and a new European onshore gas strategy targeting potentially much larger opportunities, Buccaneer Energy is beginning to look very different from the company it was a year ago. Here to tell us more is CEO Paul Welch. Thanks for joining me, Paul.
Thanks for having me, Darren. Good to be here.
Okay, so Paul, let's start with Texas operations then. You've steadily increased production to 135 barrels of oil per day now. That's a 150% increase in 2 years. Between Pine Mills and Fuke, you're now generating positive cash flow. Congratulations. Right. I think that was as much as $250,000 in May 2026 alone, and that obviously was helped by higher oil prices. You must be pleased with the current performance of the fields and the progress you've made.
Yeah, we definitely are pleased with that. I mean, again, so it took us a while to get to profitability, but we're there now. The oil price increases certainly help. So as you point out, in May we made $250,000, bucks in cash. So, I think to put it in people's perspectives, that's almost 10% of the market cap, right, in a month, right? So now that oil prices have come off a little bit, we're between 185 and 200, 215, depending on the field expenses and what the oil price does. Because we sell oil, I'm saying on a daily basis, we sell it in lots of 150 barrels, so people come and haul it away. So depending on when we sell, we'll get the prevailing price, and so we're going to get an average of that monthly price that people see on the screen. But we're super happy with the being profitable. We're super happy with the increase in production that we've seen, and then again generating cash now. This is what we needed to do to kind of close the gap between what our reserve report says we're worth, which is over $11 million, and what the market's saying we're worth, which is around $2 million. So that cash flow certainly helps, and again, that's repeatable. That's every month, between about $200,000 a month. So again, 10% of the market cap a month, that definitely adds up. So we're excited about that.
Okay, and in terms of expansion, you recently acquired Carlisle 1 in the Fuke area. What did you pay for that acquisition, and when do you expect to see a return on that investment?
Okay, so we paid in March. We paid $425,000 for that. That was backdated to January 1 of 2026. So we owned it effectively from the first of the year. We've been generating, again, depending on the oil price, between $50,000 and $70,000 a month in free cash flow from that one. So we're just nearing payout on that. So I don't know how you define generating a return, but payout will be one indice what we could use, and we should pay out this month or early next on that acquisition. Now that's just phase one or part one of the acquisition story there. So the well will pay out, and we're making between 26 and 30 barrels a day on that well. It's been pretty steady, but where that was really important to us is that feeds into the Fouke water flood that we're implementing. Looks like October now, and that allows us to increase our equity percentage in that area from around 32.5%, which is which I inherited when I came on board, to closer to 50%. So the great thing about that Fouke area is it has low costs, and when we put it under water flood, we're going to double the reserves that we produced it on primary, which is where we don't have a water flood in place. So we're going to get double the reserves that we saw in primary from the water flood. So when you add that to the Carlisle already paying out, you can see we're getting an above market return on the investment of this asset. So the internal rate of return at the moment is probably in excess of 80%-ish, and it'll go up from there. So that was a really good acquisition for us, very strategic. We bought it at the right time in the price cycle. The Iranian war, which obviously we had no foresight on, certainly helped the return there, but the return is there nonetheless, and so we're pretty excited to have that in our asset base at the moment.
Well, it sounds like a good deal, because if it's nearly paid off or paid for itself, then it's a well that's just going to keep pumping.
It does. I mean, don't forget, these things do decline. It'll decline and put the water flood, but we've seen a solid 26 to 30 barrels a day. Not much decline since we picked it up. So yeah, we're really after this month, it's truly free cash generative. I mean, the operating costs there are like the rest of the Fouke area, between $3 and $5 a barrel. So the net back on that production is very large. Really, it's true. Onshore Texas production where very low operating costs and very high margin, and so that's what's exciting about that one.
Yeah, and you briefly touched on it there. I wanted to ask you about the upcoming waterflood and organic oil recovery programs, which I think you said are in Q4. How do you
Right.
see those assets collectively impacting on your overall reserves and the near-term production?
Okay, so let's start with the Falcon area water flood. So the Falcon area water flood, we've done all the technical work. The final maps will be complete this week, and then we have a bit of a discussion with our partner about how we're going to split up the equity there. Obviously, we have views, they have views. We have to come to some agreement, and so that process is ongoing. That will take the better part of next month, essentially, to hammer out. And then, because we're already water flooding the area in Pine Mills, which is one fault block away, implementation of a water flood there is really pretty simple. We just have to take one of the wells, convert it into an injector that we have permission to do already, and just start putting water in the ground. So startup for that is relatively quick. We expect that will increase production there in the Falk area by about 50 barrels a day gross. So that'll be, in rough numbers, 25 barrels a day net to us, we think, and so that will start. The water flood will start in October, we think, late October, early November, and then we'll see a steady ramp up in production from that point. So by the end of the year, we should see that full 50 barrels a day, we think. In the case of organic oil recovery, that's behind a couple months. That project has been pretty busy. The service company that's working on it has been busy working on another big project for that. So we were one of the first in the U.S. to do it. It was really successful when we tested it, and then I guess word got out, and the service company did a great job in marketing it. And so they've been busy, putting it into other fields in other parts of the world, beyond just Texas. And so they have a blending facility just in Texas, which is nearby, but they've been kind of like, I think, full bore working on another big project. So that project has essentially been pumped and done. And next they'll come to us. So we think next month we'll do the next treatment. That will, if it's as successful as the first one, that'll add another 15 barrels a day in the pilot area. And then the nice thing about that is that the pilot area for that is up in the northern part of the Pine Mills field, and the Falk water flood is in the south. So the two things are completely separate from one another, easy to manage because they're very different parts of the field. So we expect that'll add another 15 barrels a day. So, and that's net to us. So. By the end of the year, we're looking at between 200 and 250 barrels a day gross from Pine Mills in the Falk area net to us. So that's what we're targeting. Probably closer to 200, I would say, at this point. And the commensurate cash flow with that will obviously increase. So the production that we generate here in the U.S. is really helpful in paying overhead, paying bills, and allowing us to expand into other areas. Like we've mentioned before, we're talking about an opportunity in European gas, which is pretty exciting for us.
Yeah, so it sounds like Texas is sort of stable now. You've managed to increase production. You've still got room for expansion, which is good, and that's all going to hit the bottom line. And as you say, it's sort of a self-sufficient operation, and it will help you, be able to manage, future cash requirements. So that's fantastic. You mentioned it there, and this is something I think that's caught investors' eye as well, because it's a meaningful announcement and it's quite exciting if it comes to fruition. You've recently announced that you were looking to venture into European onshore gas. Can you tell us what you're looking at there and why you're looking at it now?
Okay, I'll start with the now, and then I'll tell you what we're looking at. So, the reason for now is European gas prices are high, at the moment quite high. The Henry Hub price for natural gas in the U.S. is around $2.75 an MMBTU, maybe $3. That's where it sits. It's somewhere in there. Whereas in Europe, you're at the moment, depending on what part of Europe you're looking at, it's $23 to $24, right? So it's a 10x increase. Now, the reason for that is that there's just not a lot of gas production. There's a lot of gas demand, and the gas production needs were met in the past by a combination of sources outside of Europe, Algeria, Libya, places like that, Russia in particular, and then LNG flows into from places like Qatar. The European gas supply chain is dramatically changed due to the conflicts around. So the Russian gas has essentially ended. It will officially stop at the end of this year, so there'll be no more Russian volumes coming into Europe. And then secondarily, because of the conflict in the Mideast, the Qatari volumes, the LNG volumes that were coming into Europe are also restricted. So you're seeing a scarcity of supply coming to a market that has a lot of demand. And then there's very little storage, gas storage in Europe itself. So whereas in the U.S., we have a tremendous amount of storage, there isn't the storage capacity available. So you can't inject in the summer when prices are low and then take it out in the winter when prices are high. There's just not enough capacity available to do that at the moment. So as a result, prices are high, and that's one of the underlying currents. The second thing is people have recognized that there's been a lot of I would say barriers to entry for E&P developments in Europe, just for green reasons, other reasons, people. And also the fact that you had a tremendous amount of volume coming in from Russia primarily, so there wasn't really the need to develop it. So there wasn't the word of energy security or the worry about energy security that you see now. So host governments, particularly I would say Germany, Austria, Italy, to a lesser extent France, are concerned about energy security, and so as a result of that, they have opportunities, onshore and offshore, to develop their own resources that will make them less dependent upon the market and supplies constraints that you see there. And so they've changed the way in which they've approached this business. So they've made it a lot easier for companies like ourselves and others to go in and develop these opportunities. Now, in some cases, these opportunities have been off limits for 10 years, and in 10 years, technology has marched on, making those volumes a lot easier to see from the subsurface, and then given the prices, a lot easier to monetize. So the market dynamics have changed a great deal, and that's why we started to look at it in earnest probably about 6 months ago, because we were looking for a way to add scale that wasn't as competitive as we see in the U.S. Now, we've done some good things in the U.S., but we think we're getting in there early, and we think we have a great team, and so that combination of essentially pieces there made us very, very bullish about going into onshore Europe, and so that's why it's now, and that's why we announced it, because we are dead set to do it, and we think we can add the kind of volumes we need to get to be that mid-tier producer that we're trying to aspire to be.
And it seems that these countries, these European countries, have no choice other than to actually start looking at their own resources. So from that perspective, I guess that is why it is good timing.
Right,
Yeah.
and I think they're doing the right thing, because again, European gas prices are just far too high, and if you have the indigenous resources there, it's very easy to develop it. Not easy, well, it's easier to develop in-house, and then you're going to get that at a fraction of the price of what you're paying in the open market. So it makes sense for host governments to to look for these types of opportunities, and there's a lot of them there. There's a lot of availability for those. Yeah.
So you mentioned team there. Can you tell us a bit more about the partnerships and the team that you've assembled for the European strategy, and how their experience, will help in bringing about what could potentially be a transformational transaction for the company?
Yeah. So the team is from a group called Orion Resources. We have a joint venture with them. There's a company in the distant past called Independent Resources. I don't know if you remember them, but they were kind of the core of Independent Resources. They did a lot of work in onshore Italy and other parts of Europe, and they are responsible for a number of discoveries around the world. The team itself. So Robert Bassini and our chairman Steve Staley have made a number of very large discoveries, in Europe and beyond, and so that team and ourselves have looked at over. I think we're at close to 300 opportunities to screen down to the 3 to 4 that we think are worth chasing. And again, it's based on data that we had, opportunities that we've come across in the past, those type of things, and the experience they have. So like Steve, made the big discoveries that were part of Cove. So they had a $4 million market cap company that they sold, for $1.2 billion.
Right.
And Robert made a lot of the big discoveries for Lasmo, so like the Elephant Field in Libya and others, around the globe. So these are world-class explorers and developers, and so that's why we're excited to have them on the team. And again, having gone through a process, kind of behind the scenes of working up all this data, we can now get to the execution phase, go to these host governments, select the opportunities we want, and then develop them quickly. So that's why it's now, and that's why the team, the two things came together. The team being really the key here. With them on board, we have the ability to get in and get up to speed very quickly, and so that's why we executed on that.
Yeah, and it's interesting what you said earlier about the scale element of it. I guess what you're saying about the Texas oil business that you've got. Yes, it's stable, it's useful, it's generating cash flow, but it sounds like you're seeing Europe as an opportunity that could be take you to the next level, for example.
Exactly. Yeah. I mean, we think we could get there, and we could definitely get there in Texas, but it'll take some time. And the opportunities, and as I think I've said to you or other people, the opportunities here are becoming expensive because there's a lot of people with these higher prices that are chasing opportunities that weren't chasing them before. And so, like when we did the Carlisle opportunity, the oil prices were flat at $65, $66, flat out into the future. Now, the shape of that forward curve is much different, and so people have a different view of it. So if you think that oil is going to be $80 or $90 into the future forever, you're going to be paying a lot more for an asset than someone that thinks it's going to be $60. So there's a bit of a mismatch between opportunities there, and so that's why we kind of moved, up the food chain a little bit to go after something that's closer to development / exploration, because we don't have the competition for acreage that we would have for a producing asset like we see in Texas. Now, we're not ruling out looking for other assets in both here, because we continue to look for assets in the U.S., but also looking for assets in Europe as well that are producing or near to the areas we're exploring. So that's another thing we're looking at. Clearly not excluding that, but at the moment our focus has been on picking up these opportunities that are essentially a fault block away from a producing asset that we've seen in the past that was off limits because the government said, look, you can't develop it anymore, to now saying, please come help us develop it. So that's the change, and that's why we've essentially pivoted to this second branch of the story, I'd say.
Okay, well that brings me, you saying about the government saying, yeah, please help us develop it. Question on investors' lips is going to be, we've touched on it already in this interview, that you're currently 2 million market cap, which seems rather ludicrous given the cash that you're generating already from Texas alone. But how do you go about potentially funding an acquisition? I mean, I think there's some, fairly punchy numbers in what some of these assets could, or what you're targeting for them to actually be worth. I think I saw 250 million NPV. Correct me if I'm wrong.
I think it's 500. That's okay.
500 million NPV. Okay, right. So hugely meaningful for a company of your market cap. But again, the question I guess therein comes in is how would you approach funding such an acquisition?
Right. So let's just again, buying an asset aside, which is something we'd have to go and fund, in the market. But what we're looking at the moment is picking up acreage, developing it, and getting to the point where we need to drill either an appraisal well or an exploration well. We have going into it, we'll have 100% of the equity, and the way we envision financing that is farming down a portion of that. So right. Given our size, we don't need to keep 100% of this opportunity to make it meaningful to us. Again, our target NPV 10 for the assets that we're looking at the moment is $500 million. 10% of that is meaningful to us. 25% of that is incredibly meaningful. So, if we can get through the process of getting to, developing production, and we maintain a quarter of that, we would be super happy. So the idea is to develop the opportunity, create an opportunity for us and others, and then have people farm in and help us fund this as we move forward. So that's really the plan at the moment. It's been done in the past. I've done it in the past with other companies, and so at the moment we're really thinking it's going to be a develop, farm down, use other people's capital to help us develop it, and then take a percentage of the equity as we move forward. Ideally, we'd be somewhere between 25 and 50%, depending on the opportunity. So that's our plan for developing what we consider to be a large opportunity in the future.
And perhaps if you get through that, you then go and do it again. Okay, so that takes me on to actually my last question then. Looking forwards, Paul, what are the Buccaneer board looking to achieve over the next year, and perhaps even longer term, in terms of target production, growing the company? We've talked about it before. You're currently only 2 million market cap. Do you have a longer term view to build perhaps a mid-sized E&P company?
Yeah, we definitely have to be a mid-sized E&P company. I mean, I guess over the next year, what we'd like to do is pick up 3 additional opportunities onshore Europe, keep our production, get our production up to 200 to 250 barrels a day in the U.S. So we, got our overhead covered, servicing our debt, that sort of thing, and then looking for pharma partners to take us to the next level, which would be to get to be that mid-tier E&P company that is producing between 3,000 and 5,000 barrels a day. I mean, again, that's the 3 to 5 year growth plan. We were trying to do it all onshore U.S., and we recognized that wasn't going to be a long slog and going to take a lot of capital to do that. So, having looked around for opportunities, we think we can get there, with a much lighter capital program. Looking at onshore Europe, for the reasons I mentioned, energy security, host governments much more favorable, and the energy pricing we see in that market. Now, that energy pricing is not going to be there forever, but we think that longer term, the European gas prices are going to be 2 to 3 times higher than the prices are in the U.S., and so that's going to be a sufficient margin to develop any of the opportunities we're looking at the moment. It's just a very robust place to do business. Now that you can do business, and that the governments are encouraging you to do that, so they can get the energy security that they're looking for. So that's what we see in the future for the business.
Mm. And I guess you said you nailed these European potential projects down to a handful now. When can investors? It's probably the golden question, but when can investors expect to maybe hear more news on that front then?
I would say more news on that front will be first to second quarter next year. I mean, again, a lot of it has to be, there's competitive periods where if we go out and pick up a project, we need to keep quiet about it until the government awards this. So I would say, late first quarter, early second quarter next year is when we can really start to talk about opportunities that we own and then are looking to develop and promote. That's what I would expect. If something happens quicker, obviously we'd love to tell people about it, but I think it's a realistic time frame at this point.
Okay. All right. Well, fascinating to chat again, Paul, and great to hear that the Texas business is stable and has progressed so far, and we'll look forward to hearing for that news on potential Euro acquisition.
Thanks very much. I really look forward to telling everybody about it. We're really excited about it, and again, with the team on board, I think it's going to be a great place to a great story to tell as we develop it.